Have you ever wondered where money actually comes from? I'm not talking about your paycheck or your birthday card from grandma. I'm talking about the actual dollars themselves, the money that flows through the entire economy. Most people think governments print money and that's basically it. But here's what nobody tells you. The way modern money gets created is so bizarre, so counterintuitive, that when you first learn about it, you'll think I'm making it up. Here at Simple Money, we've spent countless hours breaking down how the financial system actually works. And today, I'm going to show you something that will fundamentally change how you see every dollar in your wallet. Because once you understand this, you'll never look at money the same way again. Here's what's really happening in the economy right now. Every day, billions of dollars are being created out of thin air. Not printed, created. And the wild part? Most of it isn't even created by the government. Think about that for a second. When you hear about the money supply growing, you probably picture massive printing presses running day and night, churning out fresh bills. That's what I thought too. But physical cash, those bills in your pocket, they make up less than 10% of all the money in existence. So where's the other 90%? It exists only as numbers in computer systems, digital entries. And here's the really mind-bending part. Most of that digital money was created by regular banks, not the government. Banks. Your local bank, the one on the corner where you have your checking account, has the power to create new money every single day. And they do it through a process so simple, yet so profound, that entire economies rise and fall based on how much they decide to create. This isn't some conspiracy theory. This is exactly how the system is designed to work. And understanding it is the key to understanding why prices go up, why some people get rich during certain times while others struggle, and why financial crises happen in the first place. Let me walk you through how this actually works. First, let's talk about what I call the government's magic button. When a government needs money, it has options. It can tax people, it can borrow money, or it can do something that sounds absolutely insane. It can just create it. Here's how it works. Let's say the government wants to spend $100 billion on infrastructure. Roads, bridges, whatever. But it doesn't have $100 billion sitting in an account somewhere. So the Treasury Department, which handles government money, issues bonds, these are basically IOUs, promises to pay money back later with interest. Now here's where it gets interesting. The central bank, in America that's the Federal Reserve, can buy these bonds. But wait. Where does the Federal Reserve get the money to buy $100 billion worth of bonds? They create it. Literally. Out of nothing. A person at the Federal Reserve types some numbers into a computer. Those numbers represent money. And boom, that money now exists. The government's account goes up by $100 billion. Money that didn't exist 5 minutes ago now does. No gold backing it up. No pile of assets. Just a decision and a keyboard. This is called monetizing the debt, and while it sounds completely made up, it's standard operating procedure in every modern economy. The government now has money it can spend on roads, schools, military, whatever it wants. That money flows into the economy, construction companies get contracts, workers get paid. They spend that money on groceries, rent, car payments, and just like that, money that was created from nothing is now circulating through the real economy. But here's the thing. This isn't actually where most money creation happens. This is just the foundation, the warm-up act. The real magic happens in regular banks. Which brings me to the second thing you need to understand. I call it the banking multiplier effect. Let's say you deposit $1,000 in your checking account. You probably think that money just sits there waiting for you to spend it, right? Wrong. The moment you deposit that money, your bank is allowed to lend out most of it. Not all of it. They have to keep some in reserve. In the U.S., historically that reserve requirement has been around 10%, sometimes less, sometimes it's basically zero. But let's use 10% for easy math. You deposit $1,000. The bank keeps $100 in reserve, and then it lends out $900 to someone else. Now here's where your brain should start hurting. That person who borrowed $900, they didn't take your money out of the economy. They still have $900 in their account, and you still have $1,000 in your account. Wait, what? You have $1,000. They have $900. That's $1,900 total. But you only deposited $1,000. The bank just created $900. Out of nothing. just by making a loan. But it gets crazier. That person with $900, let's say they use it to buy something. They pay a business. That business deposits the $900 in their bank. That bank now takes the $900 and keeps 10% in reserve. That's $90. And they lend out $810 to someone else. Now there's $1,000 in your account, $900 in the first borrower's account, and $810 in the third person's account. That's $2,710 from your original $1,000 deposit. This process keeps repeating. Each time money gets deposited, banks lend out 90% of it. Each loan creates new money. By the time this chain reaction finishes, your original $1,000 deposit has turned into roughly $10,000 in the economy. 10 times the original amount, created out of thin air through the banking system. This is why it's called the money multiplier. And this is how the vast majority of money in existence gets created. Not by governments, by banks making loans. Every time someone takes out a mortgage, a car loan, a business loan, or puts something on a credit card, new money is being created. The bank doesn't have to have the money sitting there. They just create it when they issue the loan. Mind-blowing, right? Now, the third thing you need to understand is what I call the destruction process. Because money doesn't just get created, it also gets destroyed. And this is the part that nobody talks about. When you pay back a loan, money disappears. Let's go back to that $900 loan from earlier. When that person pays back the $900, it doesn't go back into the general money supply. It gets deleted. Poof, gone. The bank's accounting ledgers just erase it. The money that was created when the loan was made gets destroyed when the loan is repaid. This is why banks are so obsessed with lending. It's not just about the interest they earn. Every loan they make literally creates new money. And as long as that loan is outstanding, that money exists in the economy. But when loans get paid back faster than new loans are made, the money supply shrinks. There's less money circulating, which means less spending, which means businesses make less money, which can lead to a recession. This is what happened in 2008 during the financial crisis. Banks stopped lending. People started paying down debt. Money was being destroyed faster than it was being created. The money supply contracted, and the economy collapsed. This brings us to the fourth critical piece of this puzzle, what I call the inflation connection. You've probably heard that printing money causes inflation. And that's sort of true. But now you understand it's not really about printing. It's about creation. When governments create money through the central bank, or when banks create money through lending, more money enters circulation. If the amount of stuff you can buy stays the same, but there's more money chasing it, prices go up. It's basic supply and demand. More money, same amount of goods, higher prices. But here's what makes this tricky. Not all money creation causes inflation. If banks are lending money to businesses that build new factories, hire more workers, and produce more stuff, then you have more money and more goods. The ratio stays balanced, no inflation. The problem happens when money gets created but productivity doesn't increase, when governments create money to fund spending that doesn't lead to economic growth, or when banks lend money for speculation, for buying existing assets like houses or stocks, instead of funding new production. That's when you get inflation, more money bidding up the prices of the same amount of stuff. This is why some economists lose their minds when central banks create tons of money, because they know what can happen. Too much money creation without corresponding economic growth equals inflation. Your dollars buy less, your savings lose value. But here's the flip side, what I call the deflation trap. And this is the fifth thing you absolutely need to understand. If money creation is so dangerous because of inflation, why don't we just stop creating money? Because deflation is actually worse. When the money supply shrinks, when there's less money chasing the same amount of goods, prices fall. That sounds great, right? Everything gets cheaper. But think about what that means if you're in debt. If you borrowed $100,000 for a house, but then deflation happens and your income drops by 20%, that debt becomes harder to pay back. The real burden of your debt increases. If you're a business and your revenues drop because prices are falling, but your debts stay the same, you might go bankrupt. This creates a vicious cycle. People can't pay debts. Banks lose money. Banks stop lending. Money supply shrinks more deflation, more defaults, more banks failing. It spirals. This is what happened during the Great Depression. The money supply collapsed by about a third. Deflation took hold. And the economy didn't recover until the government started creating massive amounts of new money. So modern central banks walk this tightrope. Create too much money, you get inflation. Create too little, you risk deflation and economic collapse. They're constantly trying to create just enough money to keep the economy growing without triggering runaway inflation. It's an impossible job, which is why they get it wrong so often. But here's what nobody wants to admit. This entire system, this ability to create money from nothing, it's both incredibly powerful and incredibly fragile. It works because of one thing, and one thing only: trust. Think about it. Money is really just an agreement. You accept dollars because you believe other people will accept them. Banks can create money because you trust that money is real. The moment people lose faith in the system, the moment they stop believing that the money has value, the whole thing falls apart. This has happened throughout history. Weimar Germany in the 1920s, Zimbabwe in the 2000s, Venezuela more recently. Governments created so much money that people stopped trusting it. Hyperinflation took over. Money became worthless. You'd see people carrying wheelbarrows full of cash just to buy bread, because the government destroyed trust in their currency by creating way too much of it. That's the dark side of this power. It can be abused, and when it is, ordinary people suffer the most. Let me tell you about two people who experienced this system very differently. Let's call the first one Marcus. Marcus worked a regular job, saved his money diligently, and kept most of his savings in a regular bank account. He was proud of his $50,000 emergency fund. It made him feel secure. But over a 10-year period, something happened that Marcus didn't fully understand. The central bank, responding to economic challenges, created massive amounts of new money. They wanted to stimulate the economy, get people spending. The money supply grew significantly. And while the economy did grow, inflation started creeping up. Nothing dramatic at first, just 3% a year, 4%, then 5%. Marcus noticed his groceries cost more, his rent went up, gas prices increased. But his savings account still showed $50,000. The number didn't change. Here's what Marcus didn't realize. With 5% inflation per year, the purchasing power of his savings was being cut in half every 14 years. That $50,000 could buy less and less each year. After 10 years, his $50,000 had the buying power of only $30,000. He lost $20,000 in real value without spending a penny. The government and banks had created so much new money that his money was worth less. Marcus felt like he'd done everything right. He saved. He was responsible. But the invisible hand of money creation had quietly stolen his wealth. Now, let me tell you about someone else. Let's call her Diana. Diana understood how the system worked. She knew that when central banks create lots of money, it flows into certain places first, usually into financial assets, stocks, real estate, things that people with money buy. So instead of keeping her savings in cash, Diana bought assets. She invested in the stock market. She bought a rental property. She understood that as new money got created, it would flow into these assets and push their prices up. And that's exactly what happened. Over that same 10-year period, the stock market roughly doubled. Real estate prices increased significantly. Diana's investments grew. She didn't work harder than Marcus. She wasn't smarter. She just understood that in a system where money gets constantly created, holding cash is a losing strategy. You need to hold things that benefit from that new money creation. By the end of that decade, Diana's wealth had grown substantially. Not because she earned more, but because she positioned herself to benefit from how money creation works. Same economy, same money creation, two completely different outcomes. Here's what most people don't realize. The way governments create money isn't neutral. It doesn't affect everyone equally. There's something economists call the Cantillon effect. When new money gets created, it enters the economy at specific points, usually through banks and financial institutions. The people and institutions closest to that money creation get to spend the new money before prices rise. They can buy assets, make investments, hire people, all while prices are still at old levels. They benefit first. By the time that money trickles down to regular workers, to people like Marcus, prices have already started rising. They get the new money last, after it's lost some of its value. This is why wealth inequality tends to grow during periods of massive money creation. The people who understand the system, who hold assets, who are close to the financial sector, they benefit. Everyone else sees their purchasing power slowly eroded. It's not a conspiracy. It's just how the mechanics of money creation work. First spenders benefit more than last spenders. This is the uncomfortable truth about the modern monetary system. It's designed in a way that advantages people who understand it and hold assets over people who just work and save cash. And here's the thing. Most people never learn this. They're never taught how money really gets created. They're told to save, to keep cash for emergencies, to be financially responsible. All good advice on the surface. But in a system where money is constantly being created, where the money supply is always expanding, just holding cash means you're slowly getting poorer in real terms. Understanding this changes everything. It's not about being cynical or paranoid. It's about seeing the system clearly. Once you understand that money gets created from nothing, that banks multiply every deposit, that inflation is a feature of the system, not a bug, you can make different choices. You can choose to hold assets that benefit from money creation. You can understand why certain investments make sense in certain economic environments. You can protect yourself from the invisible erosion of inflation. The people who succeed financially in the modern world aren't necessarily harder workers or smarter savers. They're the people who understand how money flows through the system, where it gets created, where it goes, and how to position themselves accordingly. This knowledge isn't about getting rich quick. It's about not getting quietly poor by doing everything you were told was responsible. Look, I know this is a lot to absorb. The idea that money just gets created from nothing, that your bank can multiply deposits, that inflation is built into the system, it all sounds crazy at first. But this is reality. This is how every modern economy works, and pretending otherwise just means you're playing a game without knowing the rules. The money creation process, the banking multiplier, the constant threat of both inflation and deflation, these aren't problems to be solved. They're features of the system. Understanding them doesn't mean you can change them, but it does mean you can adapt to them. You can make informed decisions about where to keep your wealth. You can understand why diversifying beyond cash makes sense. You can recognize what's happening when central banks announce new policies. You can position yourself to benefit rather than be victimized by the system. Because at the end of the day, governments will keep creating money. Banks will keep multiplying deposits. The system will keep doing what it's designed to do. The only question is whether you understand it well enough to protect yourself and maybe even benefit from it. The government's ability to create money from nothing isn't going away. It's too useful, too powerful. And honestly, without it, modern economies probably couldn't function. We'd be stuck in a world of deflation and depression. But that power comes with consequences. Inflation, wealth inequality, boom and bust cycles. These aren't accidents. They're the natural result of a system built on money creation. Once you see this, you can't unsee it. Every news story about the economy, every announcement from the central bank, every change in interest rates. It all makes sense when you understand the fundamental truth. Money is created from nothing, constantly, by design. And that changes everything.